The Bitcoin halving is here. For those of you new to Bitcoin, this video will give you an introduction to Bitcoin. What is the Bitcoin halving? Why is it such a big deal? And why is the media and everyone seems to be talking about it? So, what is Bitcoin? Bitcoin is created, distributed, traded, stored using a decentralized ledger system known as a blockchain. A blockchain is a shared database of information that is chained together via cryptographic techniques. It is decentralized because it is stored on many computers rather than on a centralized server, as is typical of data storage today. These computers, known as nodes, secure the Bitcoin network and verifies and records all transactions on the network. So, the more nodes in a network, the more secure and stable the network is. Bitcoin was initially designed and released as a peer-to-peer payment method. However, its use cases are growing due to its increasing value, competitions from other blockchains and cryptocurrencies, and advances in blockchain technology that are adding more functionality to Bitcoin. What is the Bitcoin halving? Every 4 years, the amount of new Bitcoins created gets cut in half. This means that when Bitcoin halves, the reward given to the contributors securing the network is reduced by 50%. This directly impacts the rate at which new Bitcoins are introduced into circulation. At the beginning of 2020, 12.5 new Bitcoins were added to the network every 10 minutes via virtual mining. In May, that amount was halved to 6.25. In April 2024, it will drop again to around 3.125, and the process will continue until all 21 million coins have been mined. And this is why Bitcoin is referred to as digital gold, because when all Bitcoins are mined, of which estimates say should happen around year 2140, there will be no more Bitcoin. And this process has been coded into the Bitcoin protocol by Satoshi Nakamoto, the creator of Bitcoin, as a way to limit the total supply of Bitcoin, thus increasing its scarcity. Why would they cut the number of new Bitcoins produced by half? To understand why this happens, I have to explain how Bitcoins are created. Unlike the central banking system that decides how much money gets circulated in the supply, Bitcoins are created as a function of a consensus model. A consensus model is a technical way of saying agreeing on the state of things, because we need to agree on how many Bitcoins you have or how many that I have, because we can't just say, trust me, I have 10 Bitcoin. That's a consensus model based on proof of talk, which we all know isn't very useful because anyone can say anything they want. So to agree on the state of things, developers have come up with several ways to do that. For example, Ethereum uses proof of stake, which means if you have enough Ethereum tokens locked up, you can help validate transactions. And as you go deeper down this rabbit hole, you're going to find many different ways to agree on the state of things. Bitcoin uses a consensus model that's based on proof of work to solve complex mathematical equations. The downside of proof of work is that it uses a lot of energy. It's slow, and it's not very efficient. Granted, a lot of the energy used by Bitcoin miners are from sustainable energy sources, but I'll leave that for another time. The trade-off is that this is extremely secure, which is why it's a good fit for the application of value that makes Bitcoin. How do you incentivize anyone to work on solving these resource-intensive puzzles? Why would anyone buy these expensive machines that are loud and hot and use a lot of electricity? The answer is block rewards. A block and all of its rewards get created on Bitcoin every 10 minutes. Think of it like a bus stop. Every 10 minutes, a bus comes along and then takes off, and another bus takes its place. If you want to get on the bus, in other words, you want to get your transaction included on the blockchain, you have to pay the bus driver of that bus. If you don't pay enough money, you might get stuck at the bus stop waiting for the next bus. And that means your transactions get stuck in the mempool. Since Bitcoin is a public blockchain, you can check yourself how often people are transacting on the blockchain and even follow your transactions. And over time, you can see that Bitcoin transactions have grown a lot since it was first created. If a Bitcoin is created every 10 minutes today, that block gives 6.25 Bitcoin as rewards. And Bitcoin is currently $63,000. And that means Bitcoin miners get $393,750 for each block they successfully mine. So what happened to Bitcoin's price in the previous cycles? The first one happened in 2012, and the block reward was cut from 50 to 25, or 3,600 Bitcoins per day. 1 year after halving, Bitcoin's price increased by more than 8,000%. The next halving occurred in 2016, where the block reward was cut from 25 to 12.5, or 1,800 Bitcoins per day. 1 year after halving, Bitcoin's price increased nearly 3 times. And in 2020, the block reward was cut from 12.5 to 6.25, which is now 900 Bitcoins per day. 1 year after halving, Bitcoin's price increased by more than 500%. In 2024, the block reward will be cut from 6.25 to 3.125, which lands us at 450 Bitcoins per day. And who knows what's going to happen to the price. So now it's becoming twice as expensive for miners to secure the network. So only the most efficient miners stay on the network. That's because it doesn't make sense to continue mining if the cost of hardware and electricity is higher than the cost of Bitcoin. So when those miners leave, the difficulty of solving those blocks automatically adjusts downward by design. So when there is more hashing power or compute power, the difficulty increases. When there is less hashing power, the difficulty decreases. The Bitcoin miners will sell Bitcoin at a slower pace until there's an equilibrium between the market price of Bitcoin and the price to mine Bitcoin. This inherent scarcity, combined with the historic increase in demand after previous halving events, foster a sense of digital rarity that could potentially put upward pressure on prices. On top of that, we have a number of Bitcoin spot ETFs that were launched where they have to hold Bitcoin. For example, BlackRock just purchased more than 10,000 Bitcoins over the last week for their spot ETF. And we're going to mine a little more than 3,000 Bitcoins per week. The demand from one institutional ETF is already outpacing the current production, and that's just one ETF issuer. While Bitcoin tends to shoot to the moon in the months following its halving, the returns from the halving day to the cycle top have shrunk. Each post-halving bull run has seen diminishing returns, but a measly 200% will put Bitcoin around $130,000, which is not to be sniffed at. What's different for the Bitcoin halving in 2024? Well, first, there's war. There's an ongoing conflict between Russia and Ukraine. And we also have rising conflict in the Middle East. We have higher inflation and interest rates. We also have institutional adoption. As institutions continue to stake a claim, BlackRock introduced its first tokenized fund, BIDL, that leverages the Ethereum blockchain for gaining new exposure to US dollar yields. Other major institutions unveiled crypto initiatives this quarter, including Citi, HSBC, and Deutsche. BTC already hit all-time high before halving, which hasn't happened before. So what happens to Bitcoin's price after the halving? Like any speculative alternative investment, Bitcoin is going to face volatility. So it will either go up or go down. Price predictions are predictions. No one knows where it's going. And if someone does tell you they know it's going, they're full of BS. I mean, if we think about it, Bitcoin had a price of $7,000 at the end of 2019. And a year later appreciated more than 300% to nearly $29,000. And it continued to surge in the first half of 2021, trading at a record high of $69,000. And then it fell over the next few months to hover to $40,000. Just because the previous cycles it's been in green, it's important to address the risks of investing in Bitcoin. So what are the risks? Many people purchase Bitcoin for its investment value rather than its ability to act as a medium exchange. However, the lack of guaranteed value and its digital nature means its purchase and use carry several inherent risks. For example, many investor alerts have been issued by the Securities and Exchange Commission, the Financial Industry Regulatory Authority, FINRA, and the Consumer Financial Protection Bureau regarding Bitcoin investing. So here are some of the risks you're exposed to in trading or investing in Bitcoin. First, regulatory risk. The continuous battle between cryptocurrency-related projects and regulators makes longevity and liquidity an unknown. As of February 2024, Bitcoin is not considered a security by the authorities, at least here in the US. But that stance could change in the future. Second, there's a security risk. Most individuals who own Bitcoin have not acquired their tokens through mining operations. Rather, they buy and sell Bitcoin and other digital currencies on popular online markets called cryptocurrency exchanges. These exchanges are entirely digital and are at risk from hackers, malware, and operational glitches. There is an insurance risk. Bitcoin and cryptocurrencies are not insured through the Securities Investor Protection Corporation, or the SIPC, or the Federal Deposit Insurance Corporation, the FDIC, but some exchanges provide insurance through third parties. For instance, Coinbase offers cryptocurrency insurance, but only for failures in their systems or cybersecurity breaches. However, any cash deposits you made at either exchange might be eligible for pass-through FDIC coverage. Third, there's fraud risk. Even with the security measures inherent within a blockchain, there are still opportunities for fraudulent activity. There's market risk. As with any investment, Bitcoin values can fluctuate. Indeed, the currency's value have seen wild price swings over its short existence. Subject to high volume buying and selling on exchanges, it is highly sensitive to any newsworthy events. So, how do you prepare for the Bitcoin halving? If you don't want to mine Bitcoin, and I don't recommend it for everyday people, you can take a simple strategy and dollar cost average into Bitcoin. For example, you can buy $1,000 worth of Bitcoin every month on a cryptocurrency exchange, like Coinbase in the US or Binance in other parts of the world. Most people will be unable to purchase an entire Bitcoin because of its price, but you can buy portions of Bitcoin on these exchanges in fiat currency, like US dollars. If you don't want to deal with cryptocurrency at all, you can also invest in Bitcoin spot ETFs from institutions like Fidelity or BlackRock. So, are you excited for the Bitcoin halving? Let me know how much Bitcoin you have or don't have in the comments. And don't forget to subscribe to get more tips on managing your portfolio.